Tito's Handmade Vodka is America's favorite vodka for a reason. From the first legal distillery in Texas, Tito's is 6 times distilled till it's just right. And naturally gluten-free, making it a high-quality spirit that mixes with just about anything. From the smoothest martinis to the best Bloody Marys. Tito's is known for giving back, teaming up with nonprofits to serve its communities and do good for dogs. Make your next cocktail with Tito's. Distilled and bottled by 5th Generation Inc., Austin, Texas. 40% alcohol by volume. Savor responsibly.
Reality radio for a really great future. We're talking real money.
Oh, you're listening and you're asking. Oh, I'm so touched. Hi, everybody. Welcome to another Friday Q&A episode of Talking Real Money, the podcast. I'm Don McDonald, and I couldn't be more pleased. Holy mackerel. You know, a couple of weeks ago, I complained that we didn't have very many called-in questions, that Tom was getting all the action with the typed-in questions, and then all of a sudden, holy cow on a bicycle, you guys started calling in or speaking in. It's not like a phone. It's hard to explain. You've gone to talkingrealmoney.com, you went to the contact form, and then you spoke your question into a mic, and they're good. Even after the questions that I have today, which are technically 7, which will be the longest episode of this kind I've done yet, I still have another 21 questions to get through. So we're going to be, just for those of you who sent those questions in, we're going to be doing some of those on other days of the week. So this may force you to listen to all the podcasts, because we're going to do some of those. We already did a couple that'll air, I think, aired earlier this week or next. I'm not sure. And then we're going to do some on Saturday shows that will air on Tuesdays and Wednesdays. And so thank you. Holy cow. I got 21 more questions to go through. And we'll probably get some more. Don't stop. We'll get through them, because the question and answer part is my favorite part. Yeah, I don't want to sit around and pontificate all the time. I'll pontificate, but I'll pontificate in response to you. And looking at the questions, yes, I do have a little bit of pontification today coming up. So, again, questions, send them in, talkingrealmoney.com, contact form. You can also call us on Saturdays at 855-935-TALK between 3 p.m. and 5 p.m. Eastern Time. And let's get started with the first one.
Hey, Don and Tom. My question is for a family member who hit the jackpot in a couple of individual tech stocks. This family member is 70 and retired at 55 with a pension that is currently around $90,000 a year. Over the past year, these very small cap stocks have grown to about $6 million in value, and they are all currently at long-term capital gains. He also has deferred compensation, or a 457, of about $300,000. He has no debt, and his pension covers all of his expenses. At the age of 70, with a life expectancy of, say, 10 to 15 more years, what do you do with these two stocks? They are very small cap stocks that fluctuate greatly day to day. How should one look at this tax situation? And yes, I've heard you say not to let the tax tail wag the dog. Also, this $6 million represents about $6 million of his total $7 million net worth. Thank you for any advice.
Well, you actually answered the question in your question when you said he hit the jackpot. Then you went on to say these are small cap, they're highly volatile, and we know, the only thing we know for certain is that he has already made a bunch of money, right? We don't know where these companies are going to go, and if we claim to, we're just lying to ourselves. We don't know. We don't know what they're going to do. They're going to go up. They're going to go straight down. Could they go down as far and as fast as they went up? Of course they could. So this is someone's life we're talking about here. Really, this is their future, their comfort, their security. And it is in a place that is highly insecure. Would you, if this family member had just won $6 million at the craps table in Vegas, would you say, yeah, let it ride. Let it ride. Just, keep playing. Of course you wouldn't. And if you won $6 million in Vegas, would you be upset to pay the government $1.5 million in taxes? Of course you wouldn't. Well, you would. You might, but you shouldn't, because this is this person's future. This will take care of terrific long-term care if needed. This will provide for absolute security and maybe a lot of joy. And you said 10 to 15 years, but what if it's 20 to 25 years? 70 is not that old. It better not be, or I'm in trouble. So I would absolutely, one, you need an advisor. You really need a fiduciary advisor. One, to sell this properly, to help you sell it at a tax-managed rate. Because I would do it slowly. I wouldn't do it all in 1 year. I'd do it at least over a couple, probably 3 or 4, but I don't know the stocks, even if I knew the stocks, I still wouldn't know what they're going to do. I'd start getting this money out. I would at least get 25% of that, so that he's now at well over $2 million in assets that he's pretty sure will be there. And then I would just start selling it. I know you could wait until he dies and people get a step up in capital gains, but they could also just go away. So it's time to start selling. Count your lucky stars and start to sell. Thanks for the question. Again, send them in, talkingrealmoney.com on the contact form. And here's our next one.
Hey, Tom and Don. Thank you for your show. I truly appreciate all that you do, and I'm grateful for the opportunity to ask my question. So my question it concerns asset allocation for investments intended to provide retirement income, but with different time horizons and uncertainty about my future employment and income. Here's some details about my situation. I'm currently employed, but my job security is unpredictable and could change month by month. If I lose my current position, my income would likely decrease significantly. 42 years old and hope to stop working full-time within the next 10 years. While I face considerable uncertainty regarding my future income, I have low monthly expenses. If I do lose my job, I should still be able to cover my living costs, though I would need to adjust my lifestyle accordingly. I have about 9 months worth of emergency savings and own my own outright. My retirement savings totals $850,000, split between traditional and Roth 401ks, IRAs, and Roth IRAs. My current asset allocation is 86% stocks and 14% bonds, diversified across both U.S. and international low-cost index funds. In addition, I have $518,000 in a taxable investment account with a similar diversification, but a slightly different asset allocation. In that one, it's 90% stocks, 10% bonds. I'm aiming to keep most of my bonds in retirement accounts. I am investing for retirement with both types of accounts, but since I cannot access retirement accounts until 59 and a half, I have recently been directing the majority of my savings to the taxable brokerage account. I continue to contribute enough to my 401k to receive the company match, and am also maxing out my Roth IRAs annually. My question is, given the uncertainty around my employment, the differing potential dates when I may need to access these funds, and my shared goal of retiring around 52, how can I best structure my asset allocation between my taxable brokerage and retirement accounts? I'm open to working part-time until age 60 to help smooth the transition. Thank you again for your guidance and expertise. Appreciate it.
Now, you also send in another question or another note afterwards, or spoke another note saying that your risk tolerance is high, that you were a, quote, 9 out of 10. So, but that doesn't enter into my answer really, because this is not about asset allocation. I mean, your asset allocation at your age is, for somebody who has a 9 out of a 10 risk tolerance, is probably not out of line. It's, if it's comfortable for you. But here's the issue. You need a plan. You really do, because you're thinking about retiring at a very young age, which makes planning even more critical, because now you've got to balance the the pre-tax money, or they got the pre-tax money, the regular account, the Roth account, and the taxable brokerage account to determine the best place to take the money to meet your needs over that period when you're going to be retired early. Now, I like the fact that you said you had flexibility, the ability and the desire to work part-time to bridge that gap. With $518,000 in a taxable account, given the amount of time you have, again, unless your lifestyle is really high, you're probably doing relatively well. I don't know what your needs are, and that's one of the biggest factors in this equation. What will your needs be between 52 and 59 and a half before you can start touching the qualified plans without a tax penalty? I don't know what that number is. You need to know that number. You need to talk to somebody and they need to help you figure that out. But bear in mind, you got 10 years. So let's say you don't add another penny to that $518,000 in the taxable account. Well, in the stock market, in actually a very balanced portfolio, historical expectations could be in the 6 to 8% range, which means you might get a double. You might get more than a double in 10 years. So that could be $1 million without adding anything to it. It's going to be based on your needs. It really is. We know what your risk tolerance is. How much money are you going to need in retirement? If you're going to need more than, say, roughly $1 million would throw off. And by the way, that $1 million, some of that can be principal because it's, again, getting you through until you can get at your bigger assets. So you need to sit down and do that calculation. What are my costs going to be in retirement? How much do I need? And then you can determine how much should go in pre- and post-tax accounts. Thanks for your question. Really appreciate it. And now to the next one.
Hey, Don. I really enjoy the Friday Q&A podcast, and I want to do my part to keep the questions flowing. So here's what I've got for you this week. I often hear people talk about having assets in 3 types of accounts: pre-tax, Roth, and taxable brokerage for flexibility down the line. My partner and I max out all of our retirement accounts, which are a TSP and a 403b, as well as our Roth IRAs every year. There's not much left over to put into a taxable brokerage account. Given the choice between contributing to Roth versus taxable brokerage, I'm thinking we should prefer the Roth, especially since we can always withdraw contributions. We currently have about 60% of our assets in Roth and 40% in pre-tax accounts. We may transition to a work-optional lifestyle in the next 5 to 10 years. We may continue working part-time, but all this would happen well before the age of 59 and a half. So my question is, going forward, should we divert some of our investing dollars from pre-tax and our Roth accounts into a taxable brokerage account, or should we keep doing what we're doing? Thanks.
You know, these questions actually came in order. They're basically the same question. Wow, what is it? I guess I'm not grasping this. Does everybody have miserable jobs? That's a lot of people who want to retire before full retirement age. What are you going to do? Have you really sat down and thought about what you're going to do with your life? You can only travel so much, or garden so much, or hobby so much, or read so much. Work optional I can kind of get as long as you realize that it'll probably be more need than option, but it could be in bad periods. But if you can't afford to add to a taxable account, then maybe you ought to reconsider that retirement early decision. However, yeah, the Roth, you're right. You can take the contributions out of the Roth, but boy, if you take those out early, it's not just the taxes or penalties that we need to consider. It's the lost opportunities. You've lost all of that opportunity going out into your seniorist years to make money tax-free, which is a huge benefit. Again, not an easy answer to this one because it requires an absolute plan. This is why we sound like a flippin' broken record when we say you should have a plan. Even if you sit down and try to do it on your own with some guidance from books and online stuff, you need to determine what might my needs be and how will those needs be met? How much money will I need to meet those needs? And how much of that money needs to be in money that I'm not going to get penalized or hurt for taking out early? And once you have those numbers, then you really can better draw a conclusion as to whether you stick with the qualified plans or you start to go to a taxable savings account for those pre-retirement needs. Thanks for the question. And remember, you can call us with questions on Saturday afternoons at 855-935-TALK. That's when we do a radio show that becomes the podcast. And that's between 3 and 5 Eastern Time, noon to 2 Pacific. Or you can send questions in at talkingrealmoney.com on the contact form. Now, we have another.
Tom and Don, if I turn 59 December 1st of this year, when am I eligible to access qualified accounts at 59 and a half? I've heard it described sometimes as the year you turn 59 and a half. So if I'm 59 on 12/1/25, does my access start 1/1/26? Or after I'm literally 59 and a half? Thanks.
Again, wanting to take retirement money out early. Oh, 59 and a half is still too early. Do we all hate working that much? Really? It's not a rhetorical question. Really? I've had lots of jobs in my life, and some of them haven't been good. But man, I cannot imagine what I would do if I wasn't working, at least some. As to your question, the date at which you can start to tap that money, short of taking it out in substantially equal distributions over your life expectancy. The date when you can start taking the money out of your qualified plans without penalty, in your case, is June 1st, 2026. It is not the year. It is the date. From June 1st, 2026 on, you're eligible to tap that money without the 10% penalty. Sorry to burst your bubble, but try and leave it longer if you can. Let's go to another question.
Hey, Tom and Don. My name is Warren, and I listen to your show frequently. Enjoy it. I like you guys are very knowledgeable and provide a lot of good information. I haven't heard you talk much about buffered ETFs, and I'd like to know what your opinion is on those. And I'm thinking of using those in my portfolio, but I'm wondering how it fits into the asset allocation equation. I recognize that the buffered ETFs are just a stock, but because they do have the downside protection, they don't seem to, I don't know if you'd really consider it purely as a stock, or does it somewhere fit in something else? So I'd like to know what your opinion is on that, and if you can give any insight, I'd appreciate it. Thank you now.
Okay, here comes my insight. If you've listened for a while, you've probably heard me go a little ballistic over a product called an equity indexed annuity or indexed annuity. The reason I hate them is because they're basically fibs. They're half-truths at best. These buffered ETFs are too. In fact, they're a lot like an indexed annuity without the annuity part. They're complicated. They're expensive. They're gimmicky. And they've been done before. In the 2000s, we had principal protected mutual funds. Very similar. Those all went away. They had high fees, and they ended up not returning the same kind of money people thought they would. You see, when you buy them, your expectation is, well, I'm going to get the return of the stock market, but there's no downside. There's no such thing as that. That can't be a thing. If you are going to protect your assets on the downside, there is always a price to pay to the upside. Always. There's no way around it. If there was a magical investment that would make me the return of my Avantis or dimensional funds and with no risk, I'm not stupid. I may not be the brightest bulb, but I'm not stupid. I would take it in a heartbeat. But I know it's all a lie. We had targeted outcome mutual funds. We have still these structured notes that are complicated. This is all Wall Street's game to sell you something that sounds magical because that's what we want. We're greedy and we're fearful, and they want to appeal to that. These ETFs cost more than regular old equity ETFs or a balanced ETF. You're going to get the same impact, maybe even a better result, just buying a balanced ETF that's 60% stocks and 40% bonds. A company that we respect that is in the mutual fund business is called AQR, and they wrote a great paper. I was trying to find the name of the paper. Oh, I can't find it here, but I did pull up a quote from it, or some information about it. They determined that buffered ETFs consistently underperform, quote, simpler, cheaper strategies. And there's a good reason, because the buffer is through the sale of options or the purchase of options, and options aren't free. You're going to pay for that. You're going to give something up. You end up with capped returns. So if the market goes up tons, you only get a portion of that. And by the way, the markets go up, or have at least in the past. They've always gone up more than they've gone down. So this is a gimmick. These should be avoided at all costs. They have zero place in your portfolio. They should not be part of your portfolio. You should ignore them, shun them, stay the heck away from them. They're bad, bad, bad Wall Street gimmicks. Thank you for your question. It was a good one. Oh my gosh, I think we're now to the last one. This is going to be the longest Q&A episode, though, I think. So here's the next question.
Hello, Don. I've got a question about home affordability for first-time home buyers. Wanted to get your take on a rule of thumb for how much of your gross income you can put towards a mortgage without being too stretched. Also, 15 versus a 30. A lot of gurus have some rules of thumb that are similar in terms of how much of your income you could put towards a mortgage. But my stomach queases whenever I look at an amortization schedule of a 30-year, and you really only putting more towards the principal than interest in like year 15. However, with a 15-year mortgage, it's just unaffordable for buying a reasonable home that you want to stay in for a long time, say 7 to 10 years. So given all those variables and a 10 to 20% down payment for a first-time home buyer, I want to get your rule of thumb, see how it jives. Thanks.
Well, it's not just my rule of thumb. It's sort of an industry rule of thumb. It's kind of a lender rule of thumb, really. And that is 25 to 30% of your gross income, as long as you don't have much other debt. If there's other debt that you have, the ratio goes to mortgage payment plus debt, no more than about 35% of your pre-tax income. So, that's why you see so many 30-year notes. That's the reason. And that's not a terrible thing, because think about it for a minute. You said long term, but you said 7 to 10 years, which for old people like me, that's not long term. 7 to 10 years was like yesterday. 7 to 10 years ago it was just a couple of days ago. I swear. You're still kind of talking about renting a home. Because the other thing is you're going to have to tie up a lot of your capital that could be growing for your future in a home that has not proven historically to be a particularly great investment. It's the leverage that makes it look better. But home prices themselves, after inflation, have over 100 years returned right around 1% per year. So they're not exactly lucrative. So consider it renting. Literally, consider it renting. you're renting the house. You're just paying your rent to the mortgage company, and you had to pay the landlord a big down payment to buy down your rent. Think of it that way. I mean, it's like paying to buy down your rent, putting the 10 to 20% in the house. And I don't think I'd look at it any other way. Because any other way is you're either not going to be able to get the kind of place you want. In fact, I mean, I'm a homeowner and I've owned a home for a long time. I bought houses and then bought another house and then bought another house and did okay. Didn't make a lot of money, but I mean, my house that I'm in right now and I've been in for 30 years, the return on my money is terrible. We did it on Tom's house. And I mean, his return literally after inflation was about 1% a year. It's really pretty sad. So you should consider, at least at this juncture in your life, renting for a while longer. There's no hurry to buy a house. It's not like they're not making any more. Renting might not be such a bad idea. I know there's that feeling of ownership, but I mean, when it comes right down to it, I'm old and I've never owned a house. I'm kind of buying them, but I don't think I'll ever really own this one because I've got a 2 5/8 mortgage on it. I'm never going to pay it off. That would be stupid. I could pay it off, but the money that I would use to pay it off is money that would make me more money than I'm paying in interest on the house. It's just a dumb financial decision. As a financial decision, buying a house is not a no-brainer. Putting a roof over your head is the goal, and sometimes putting a roof over your head is done better by renting. Think about it. Thanks for the questions. Thanks for all your questions. All of them. Lots of them. If you did speak questions at talkingrealmoney.com, start looking for those showing up on other podcasts during the week because we have a lot and we're going to spread them out a little bit. As a matter of fact, I know this weekend we're going to do a few of those on the radio show. So thank you for all of them. It's really heartening. And if you want to send in questions, go to talkingrealmoney.com. Contact form is the place to do that. You can speak them or type them. You can call our show on Saturdays at 855-935-TALK between 3 and 5 Eastern. And you can also take advantage of something that we've been offering now for over 15 years, and that is the absolutely free service of one of our 100% fiduciary advisors at Appella Wealth. They will spend some time with you. They will try to help you understand what you have and where you might be in the future. And they're going to do it without pressuring you to become a client. That's a promise. No cost, no high-pressure pitch. So go to talkingrealmoney.com, click the button that says Meet an Advisor. And in the meantime, just keep listening to these podcasts and radio shows and all the other stuff we do because there is nothing, really, truly nothing more important on a day-to-day basis in your life than talking real money.
The opinions and views expressed on this podcast were current on the date recorded.
Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone.
This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction.
Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor.
Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services.
Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.